Good morning, all. Thank you, Luke, for that very interesting update on the economy. I'll try and follow it. So, as Luke says, on to the next chapter, we'll now cover some of the tax changes announced for personal tax and private clients. So, the headline change, as you've no doubt all seen for individuals, is a further cut of 2% to the main rate of national insurance contributions, reducing it from 10% to 8%. This is in addition to the 2% announced in the autumn statement, which employees started to see flow into their pay packets from January. A 2% cut was also announced for self-employed individuals, and this will reduce the main rate from 9% in the current tax year to 6% from April. The change from the autumn statement didn't come into effect in January, and comes in from April. The tax saving arising from these changes is up to $1,500 for employees and $1,100 for the self-employed. It's worth noting that those that will benefit most are higher rate taxpayers, as they're the ones that are really benefiting from the full tax cut across that main rate band. With the general election looming, the Chancellor was clearly keen to have a headline tax cut to back up his pledge to be a tax-cutting government. Prior to the budget, there was speculation that a cut could be made to either national insurance or income tax. So why has the government opted to cut national insurance? Jeremy Hunt framed it yesterday as a cut to the double taxation on working people, and alluded to possibly going further to potentially scrap NIC when there's scope to do so. Whilst positioning it as a cut to double taxation is a clever spin, being cynical, the decision to cut national insurance rather than cutting income tax surely came down to the reduced cost of the government, particularly given the limited headroom for tax cuts. It's also worth noting that your national insurance contribution and your kind of historical record dictates the level of your entitlement to a state pension. Therefore, those that are not paying national insurance are either not getting credit towards their state pension or have already contributed and benefiting from being in receipt of a state pension. Therefore, the term of double taxation does feel slightly misleading, to me anyway. Whilst the tax saving from the changes are clear to see for employees and self-employed, there is an impact for business owners, and they should continue to review their remuneration strategy, which has historically been low salary, high dividend, but this may well change, particularly with the higher rate of corporation tax having been raised to 25% previously. The position was already marginal, and so it's worth reviewing the position again. So, as Luke touched on, the government have pledged to freeze tax bands and allowances, and again, they've stuck to this policy. The reduction to NIC has been sold as a tax cut, but is it really? It's been well publicised in the press that the UK tax burden is set to reach the highest level since World War II, largely due to the freezing of the bands and allowances. So the big question that springs to my mind is whether the NIC cut actually represents a tax cut, or is it simply smoke and mirrors to cover the impact of fiscal drag from the tax allowances and bands being frozen? If you look at the amount of tax someone earning $100,000 would have paid had the personal allowance and basic rate band been increased in line with inflation, you can see that the actual real-time tax saving is just under £400. If you roll that back to the previous 2 or 3 years, you can see that even with the NIC cut, an employee is suffering additional tax of over £1,200 a year compared to if the tax bands have been increased. I've used 100,000 to illustrate, but those savings are the same for most higher rate taxpayers, or the position is the same. Whilst the tax saving from national insurance tax cut is going to be gratefully received by many, and clearly amounts to a reasonable amount of money for most, it's difficult to accept that the government is cutting taxes as much as they'd like us to believe. This was a point which Sir Keir Starmer was keen to mention yesterday. One of the other announcements was a new ISA. So whilst all bands and allowances have generally been frozen, they are consulting on potential new UK ISA. This will give scope to invest a further £5,000 within the tax-free wrapper of an ISA. But there is going to be restrictions into what those investments can be made into. Further information is still kind of being consulted on exactly how that will look, but really the focus is on British businesses investing in UK companies and supporting the UK economy. The consultation is also looking at a number of practical points, including what investments can be made, how it would work if transfers from one ISA to another, and how to manage and monitor investments to ensure they meet criteria A business may be qualifying for UK purposes at the start, but that could change in the future. So how will they monitor that? Given the increase in interest rates, ISAs have once again become a useful tax-saving tool, with many people now finding their bank interest once again being subject to tax. It's important to utilise your ISA allowance before the end of the tax year, otherwise it's lost. So that's a month for anyone that hasn't done it yet. For years, the current child benefit tax system has been considered deeply unfair, but has recently gained more public traction, with money-saving expert Martin Lewis, among others, championing the issue. Currently, where one person in a household is earning over £50,000, they suffer a tax charge and start to repay the child benefit received, with this being fully repaid once the income exceeds £60,000. Looking at a two-child household, this creates an effective tax rate of 20.75% on top of the income tax rates, giving a marginal rate of over 60%. This is completely at odds with a progressive tax system where the rate of tax increases in line with increases in income. The 50,000 threshold has remained unchanged since it was first introduced in 2013, but from 6th of April 2024, the starting threshold will finally be increased to 60,000. It's forecast this will remove 170,000 families from having to pay the tax charge, and also take those families out of having to complete a tax return as well. The tapering band will also increase, so the full child benefit will not be lost until taxable income exceeds 80,000. This is a good step, reducing that marginal tax rate. So the effective tax rate, when you kind of cross over that 60,000, becomes an additional 11%, and flattens the additional charge and really reduces the burden for those that are crossing over. For anyone who's opted out of receiving child benefit because their income exceeded 60,000, they may need to consider applying to claim the child benefit if they expect their income to be below 80,000. I very much doubt HMRC will get in contact to tell you you're entitled to it. The longer term plan is from April 2026 to move to a system which considers overall income of a household. This is a good policy change in my view, and removes the current situation where a household with two people earning 49,000 does not have to pay any child benefit, compared to a household with a combined income of 70,000, but one person earning over 60,000, which has to pay the child benefit in full. This clearly comes with some complexity around how HMRC will consider and gather household income, and we'll wait for further details exactly how this will work. One of the key points that didn't seem to be announced yesterday of what the joint household income threshold will be. I suspect this to give a bit of room for manoeuvre in the future if the Conservatives are still in charge to decide. I must say that for once, I think common sense has prevailed and a decent, transparent and well thought out change to tax rules has been announced. It's not very often we can say that, I think. So, as covered in previous slides, tax burden for individuals remains high and is ever increasing. Therefore, it continues to be important to consider what steps you can take to help reduce and mitigate your tax liability. Pensions remain one of the key options, particularly for the employed and self-employed. As a reminder, there are some changes that came in at the start of this current tax year, which increased the amount you can put into a pension up to 60,000. This is, of course, subject to taper if you're a high earner. But alongside this, the abolition of the lifetime allowance brings pensions back into consideration for many people who have perhaps built high pension pots in the past and avoided making further contributions because they've got protections in place. Pension tax planning is quite individual to everyone, so there's not necessarily one size fits all. But where the options are limited for employees and self-employed, it would appear a good option from a tax perspective. So, in summary, some good headline news around NIC cut, but digging deeper, this only goes a little way to unravel the damage done by the freezing of bands and allowances. Finally, a fairer system will come into place for high-income child benefit tax charge, looking at household income, and whilst they get that in place, there'll be a rising at the start of the taper. Finally, personal tax planning still remains key, given the high tax burden, and pensions can form a key part of this. Alongside this, business owners should really be looking at how they're taking their income to make sure it's still the most tax-efficient manner. Thank you very much. If you have any questions at the end, please feel free to find me.